Hey everybody, this is Phil Town.
And this is Danielle Town.
And welcome to the Invested Podcast, where we're learning to invest like Warren Buffett, Charlie Munger, and other great long-time value-type investors who buy a relatively small number of companies and hold them for a relatively long period of time. They're buying them well below intrinsic value, which is what they're worth, and they're selling them when they get up to intrinsic value or more if they're not continuing to grow quickly. And this is what we're learning to do. And the reason we're learning to do it is because my daughter Danielle is learning to invest from me. And I've written a couple of good books about this. And we just finished a book that is now out called Invested, where we take Danielle through the process of learning over the last year or so, over a year period of time. And
you, Charlie Munger, and Warren Buffett, all together, teaching her to invest. And it is a really good book. If you haven't read it yet, take a second and grab it and read it. It's super good. And it's a real good basis for this podcast and for any kind of investing you're going to do. And the reason we're taking our time doing this, the reason we want you to learn this stuff, is because there is a major paradigm shift going on in the world of investing philosophy from what's been the paradigm for the last, 40 years, which says that the market's always rational and it's priced correctly and that price and value are the same thing in companies. And therefore, the only way to invest is to diversify broadly across enough stocks in the market that you get the general market result. And you can't beat the market. Nobody can beat the market. And of course, if everything that theory holds is true, then they'd be right that if all prices and values are the same, then there's no way to beat the market. But it turns out that there's quite a lot of investors who do beat the market regularly, Warren Buffett being the chief one that's known. And they beat it because those things are not true. And they're rapidly being proven to be not true by Nobel Prize winning economists like Robert Shiller and Richard Thaler, who are proving and getting Nobel Prizes for it that the market is from time to time significantly irrational and that often stock prices diverge from the values in a very significant way. And when that happens, if you are knowledgeable and if you have studied that particular company, you can buy a company that's a really wonderful business and you can buy it on sale. And when that happens, you don't have to fix toilets, you don't have to fix roofs, you don't have to deal with renters and tenants, you don't have to be a genius. All you have to do is be patient and wait for that oscillation in the market or that fluctuation in the market to happen because of some great emotional change, either greed or fear, and then step in and buy. And that's it. That's what we're learning here. Is that pretty good? Was that a good? It's too long. It's too long of an intro. But I kind of like it. It was very good. It was a little long. It was very good. And I was thinking while you were talking about how there's been a paradigm shift that I've been doing a bunch of interviews lately in support of our book, which I'll say the full title because I enjoy it a lot. And we spent a lot of time writing it. So it's called
Writing the title, actually.
Writing the title. No, yeah. I'm not joking. Like it took many iterations and many people weighed in and nobody got it right until Dad and I one day got on the phone and spent about an hour and a half just brainstorming and kicking subtitles around. And we finally got it. Yep. And then we sent it to everybody else at the publisher and said, this is what it is. No more comments. So here's what it is. And they all were like, of course, it's fantastic. It's amazing. Invested, how Warren Buffett and Charlie Munger taught me to master my mind, my emotions, and my money with a little help from my dad.
There it is.
Asterisk to Phil Town. So I've been doing all this press and interviews in support of our New York Times bestselling book, Invested. And I was just thinking when you were talking about the paradigm shift, but from this idea that a large, broadly diversified fund is kind of the gold standard of what you do with investing. Not one person has actually asked me about that as a viable alternative to what we do here, to what we how to put it, to do like sort of what I'm thinking of is stock picking, but I really hate that term. So what we do is choose individual companies and invest in them and buy it as though we're buying the whole company. And that's what my dad and Charlie Munger and Warren Buffett have taught me. And so as I've been talking about that with interviewers, now one person has asked me, oh, like, why don't you just go buy a broadly based mutual fund? What they have asked me, so my point there, now I'm getting rambly and long. My point there is that I think experientially, we are seeing that this doesn't work all that well. Like, we've gotten now 30 or 40 years of people really watching the stock market, it being accessible to us. We've got 20 to 30 years of it being really accessible to us through the internet and being able to have direct information from companies. And I think people are starting to see, and I know I certainly do, that it's not a bad method as far as returns, but it's not necessarily a great method as far as returns. And so what they do ask me is, what about buying the index in a low cost, low fee method, like an index or an ETF? Everybody has asked me that. Mm-hmm. And it's a great question. But it's just interesting to see that shift in how people are thinking about this. And I think Buffett and Munger, and frankly, you, Dad, have made a huge difference in getting this message out there. So thank you for that.
Well, you're welcome. I am really sort of fascinated that this ETF phenomenon, that an ETF is an exchange traded fund that tracks an index. And the largest one is SPY, which trades, millions and millions of shares every day, and is used by traders a lot to trade, as well as by long-term investors, and it's used in other ways as well by lots of institutions. And what it is just the very most diversified fund you can have without having to pay the fees to a fund manager to manage it. And the interesting thing about all of these kinds of, ways of getting away from actually picking a good company and owning it, which are promoted by virtually the entire financial services industry, because they love to do this stuff for you. It's not challenging for them in any way. There's no great fee earning capacity on the part of financial advisors.
Now that we have computers doing everything, it's ridiculous to charge.
I mean, they just put your money in the index. I mean, it doesn't take a brain. And of course, they subtract your rate of return by whatever their fees are, because the index is only going to give you the market return. And then you've got a financial advisor, so minus his fee to do the thing you could do on your own anyway, which is just to buy SPY in your 401k. That's all. And of course, the 401k programs, many of them are set up such that you must buy mutual funds, and they don't offer you the SPY index. And for that bit of genius, they charge even more fees. So there's a big game on, and you're the if you don't know there's a big game on around your money and your retirement money, it's like not knowing who the sucker is at the poker table. If you don't know it, you're it. And you are it.
I'm sorry to tell you, Dad, that's 95% of us.
It is, unfortunately. And of course, that's why they keep raking in over $100 billion a year in fees for virtually doing nothing. They're not doing anything. These guys are not beating the indexes. They don't attempt to beat the indexes.
They're doing a lot of stuff. Like, let's not be totally obnoxious about it. They're doing a lot of stuff. And what you're saying is that the stuff does not create the results that you want.
Well, let me tell you that what I think the stuff is that they do that has value. It's not to deal with investing. It's about how to properly handle taxation, trusts. These are for wealthy people.
Oh, you're talking about financial advisors.
These are the people who are making the fees, right? You put your money in a 401k, somebody's managing that money. Well, of course,
people who create the broadly diversified funds charge fees as well.
Little tiny ones.
No, they charge decent fees. I looked it all up.
How much for SPY?
Well, now I forgot. It's in the book. I think for SPY you just buy it. That's the index. I'm talking about a fund that is chosen companies that has.
Of course, those guys charge you ridiculous.
Yeah, that's
fees.
what I'm talking. No. To buy the index, that's not anything.
Yeah. So
we're talking about a fund where somebody picked. Then, by the way, we're getting to the technical indicators today, despite your best efforts to avoid it, Dad.
Well, it's sort of just, a backwater of misinformation. So we're just we're just going to put it out there, which of course is why I'm just sort of walking away from it. But I almost regret that I ever brought it up. But the index investor, like the index itself, is just a mathematic or a structure. It's just a concept of all, maybe in the SPY is like 500 big stocks in America. And the S&P organization.
When he says SPY, he means the Standard & Poor 500 index.
It's the ETF. SPY is the actual exchange traded fund.
I know, but what it tracks is the Standard & Poor 500 index,
right?
Which is simply a list of companies that then is indexed into an average number. Right. And then they created these financial instruments called exchange traded funds, which then track that index.
Right.
And what makes an ETF different from buying the index, so to speak, is that you can buy it directly in your brokerage account. So you can buy it and sell it yourself on a given day.
That's exactly right. Well done. And
look,
they don't charge. And here's the thing: they don't charge much for that. The S&P, that's Standard & Poor's, creates this exchange traded fund to be a very, very low cost way to buy the entire market. In other words, the S&P 500 is considered, quote, the market, right? And so this is a really inexpensive way to do it. And I think it's something like 15 basis points in it, like something really cheap like that, maybe 10, maybe 8. It's just almost not a fee. And in other words, a basis point is
like a 1/100th of a percent or something.
Exactly what a basis point is.
Is that what it is?
So there's 100 basis points per 1%. So if your advisor's charging you 1%, he's charging you 100 basis points. And if the exchange traded fund, SPY, is charging you 8 basis points, it's 8/100ths of a percent. Very, very cheap. So those guys don't charge much for that. And you can buy that SPY anytime you want. If they offered it to you in your 401k, that's a lot cheaper way to go than buying a mutual fund that tracks the S&P 500, for which they will charge you a brokerage fee. They're going to charge you a fee to manage it. There's all these fees stacked on there that often add up to well over 1%. And sometimes with some of these more esoteric exchange traded funds, they add up to 2%, 3%. And so all of that comes off of your rate of return. And when you're only making 7% on average in the S&P 500, you take off 3%, you've knocked off half of the money you're making. And over the long run, that missing piece, that fee that's being taken out by these advisors, has resulted in losing almost 50 to 60% of your retirement account. In other words, you would have had twice as much money if all you did was buy the S&P 500 exchange traded fund, SPY. You will have twice as much money in your account at the end of 40 years of investing than if you use somebody as an advisor who buys the same basic spread of stocks.
That's completely insane.
I know.
And I mean, the obvious answer is, well, I wouldn't know what to do without that person, which is the whole point of that industry.
Keeping you stupid.
That is what we're talking about here.
Exactly.
And by the way, thank goodness that we wrote a book, Dad, because I just looked it up. And it turns out that market index funds charge between 0.05 and 0.74%, usually with a minimum purchase of $1,000. And then you can add on financial advisor fees to that. Now, exchange traded funds actually tend to charge slightly more than market index funds. So I think I just said it wrong a minute ago. ETFs charge slightly more because they have that flexibility where you can buy and sell anytime you want straight through your brokerage account. And there's actually some really interesting evidence that they cost even more than that. There's an interesting article by Jason Zweig in the Wall Street Journal that talks about it. So yeah, like roughly, let's say on average, 0.5% to a little over 1% for these things without any advisor fees.
By the way, you just mentioned Jason Zweig, and I want to plug him because he is a really good writer
He is
about value investing, and he's a very strong proponent of Warren Buffett style investing. And Jason's written several books about it. He's a Wall Street Journal writer. Definitely, go to Amazon or Google ZWEIG. I think EIG or IEG.
EI. You are correct.
ZWEIG. Jason. Read anything he wrote. He's fabulous. Read everything he wrote, and you'll have a great education in this type of investing.
I've certainly got it on my reading list. He's written a couple books, and I need to really delve into them because, like you said, he is a great writer. Yep. So, Dad, I want to hear about the rabbits and the trains.
Okay, so just to quickly review, a lot of you will hear over the time of investing about technical signals that are used by traders to try to guess where the market's going to go or a stock is going to go. And these are called indicators, and there's way over 100 of them that you could possibly use. We've talked about one on the moving average called the death cross.
Oh, yeah.
Remember that one?
I forgot about that.
Death cross, which is two moving averages, a 50-day or a 50-period moving average using the daily periods, and a 200-period moving average using the daily periods. And when the 50-day, which is the shorter one, the shorter term one and moving faster one, crosses down, going down across the other line, the 200 line, it's called the death cross, and it indicates that that stock or that market is going to go down in the future. And the golden cross is the opposite. So those are the ones we've sort of talked about so far. Now we're going to add a couple more. One is called the moving average convergence divergence, and the other one's called a stochastic. And these are just three: moving average, convergence, divergence, and stochastic. These are just three, as I said, of 100 of these things. And when Danielle was mentioning the clouds, what she's referring to is when I teach about this, I basically say, look, when you're looking to figure out patterns in the stock market by looking at a chart of the index about what that chart looks like it's going to do in the future, based on what it did in the past, you are literally looking at the sky and seeing a cloud and determining it's a train.
Yeah, not a good idea. Not a good
idea.
And not even very useful to me. I mean, I'm glad we're learning this so that I know what we're talking about here. But as you guys can see, if you're just coming to us on this episode, just so you know, we've been trying to get to this now for 2 months, and we keep sort of touching on it and then getting away from it because what we actually find so much more interesting is all the long-term value investing stuff.
Yep.
But it's good to know what it is, because I do hear regularly people talk about technical indicators, and I have sort of known what they were just from seeing you use them, but I'm glad to know about sort of the ins and outs of things. So you had said MACD and stochastic are the other two, which we still haven't touched on.
Yep. So let me just define MACD for a second. We're calling it MACD because that's the initials of the words that this particular indicator has for a title: moving average convergence divergence, which is a mouthful. And so everybody shortens it to MACD, moving average convergence divergence. And a moving average convergence divergence tool is something that is basically considered a momentum indicator. So the moving average is often considered the psychological aspect of the market. So you get the death cross and you get the golden cross. The moving average convergence divergence, MACD, is more of a momentum indicator, and it is basically saying which way is the flow going in the market. Sort of, if you want to think of momentum, it's really money moving in and money moving out. So momentum going up is money, a lot of money moving in more than moving out. And momentum going down is the other opposite of that. This
chart is somehow indicating it's trying to predict the future, basically. It's saying...
Well, they're all doing that. That's what every one of these is trying to do, right? So this one is trying to predict the future based on momentum. Stochastic, as a contrast, is trying to predict the future based on overbuying and overselling. right? So those are a little bit different looks at the market. And all of this, to make sure everybody gets this, is looking at clouds and saying it's a train, not a bunny. So there are a lot of really good investors, including Warren Buffett, that don't think these things work well. And I can assure you, for anybody that has a significant amount of money in the market, they don't work at all. And the reason that they don't work at all for bigger investors is because the bigger investors are the momentum in the market.
Yeah.
So if you're sitting there waiting for one of these signals, effectively you are the signal. So if Buffett starts moving money into a company like Apple Computer, he starts driving the signals that are indicating somebody's moving into Apple Computer in a big way and creating momentum. So the MACD basically is just the relationship between two moving averages on the prices. And the typical one is the 26-day exponential moving average, or EMA, across the 12-day EMA, with the 9-day EMA as a signal line. Okay, so I know I've just absolutely blown you up there. But just
so before or last time and just now, you mentioned the death cross and the golden cross, which are also moving averages crossing each other.
Right.
And so the MACD, now you're saying, is kind of the same kind of thing, except more complicated with more crosses?
Well, think about the numbers we're using here. The 200-day moving average being crossed by the 50-day moving average, compared to the MACD, which typically uses a 26-day, not 200. Okay. So 26-day plot line against a 12-day plot line with a 9-day as the signal line. And so these are much, much shorter periods here that the MACD uses relative to the 200 and the 50. And that is only to say that this is used a lot by traders to find short-term changes in the market. And so what this is doing is basically, it's a clever way of looking at the change in momentum. So as your shorter term moving average begins to go up, you've got something indicating, wow, there's money flowing in here, and it rapidly might be coming overbought, oversold, right? Overbought typically. And you could look for a change in the market. So without getting horribly into this, to try to explain this to you while I'm just talking, let me just say that it's a useful tool if you are a small investor and the market is moving up. I think this thing can be helpful. But I don't like it anymore on this short-term basis. And I like it a little more when you're stuck in a 401k and what you own is SPY, going back to the index, and what you're afraid of is that the stock market is going to crash on you and you're going to get stuck losing 50% of your retirement again, just like in 2000 and just like in 2009. And here we are again, 10 years down the road. And it's, guess what? Time for another economic rainstorm.
You are preaching the gospel right now, because that is the exact situation that so many people are in, and so many people are worried about. How do I know when the market is actually crashing versus just sort of a 3 or 4 day little blip like we've been having lately?
Right. And I don't know anything better to use than these tools for that kind of a question, because the alternative is to just stay in there. And what happens when you do that and you're in a market meltdown is that the market will drift down 10% and then comes back up 5% and then drifts down again another 10. And at each time it comes back up, you go, oh, thank goodness I didn't get out. And then when it goes back down, your gut gets wrenched because you start to realize, oh my God, it might really crater. And then it goes back up and you're, oh, okay, I'm back into, I'm glad I stayed in. And as people learned in 2008 and 2009, with all of their advisors telling them to stay in, stay the course, eventually the pain becomes so bad that you're forced emotionally to take your money out of this monster. And of course, when you do that, it is almost guaranteed to be the bottom. And now you're out, And now you've got, oh, thank God I got out. And of course, the next blip up turns out not to be a blip. It turns out to be the beginning of a gigantic 9-year upward trend. And you missed the first 5 years of it.
An emotional rule of investing, it will be entirely because you sold at that exact moment.
Exactly.
It's all your fault.
The emotional rule of investing says that if you take your money out, the market will go up. And if you leave it in, it will continue to go down.
It'll go down.
Exactly. And so we have to have something, even if it's clouds, even if it's just clouds, we need something to get our emotions under control and to make a reasonable decision about when it is time to exit in what looks to be a recession meltdown. And that comes along, those meltdowns come along regularly. We're going to have another one as sure as I'm sitting here and you're there. And it's just a question of time before people lose another 50% of their retirement portfolio, and it takes them years to get it back. So these tools have evolved, and I think they're really useful for an index investor. I think that's where you really need to use them. So for you, as let's say you're not, but if you were an index investor,
it makes me glad I'm not doing that. I have to say.
I know it's so scary being in an index.
Yeah,
because you don't know what you own. You don't know what you own.
You do know what you own. You own the U.S. essentially. You're making an investment in the U.S. That's what Buffett says, and I think he's 100% right about that.
I agree. You're making an investment in the U.S. and the U.S. economy.
You either have to watch this stuff or you have to be willing to just ride it out for 20 years on a downturn.
Right.
And you have to have the time to be able to do that. And some of us do. And if you really just want to kind of set it and forget it, that's what Buffett recommends. So
he does, because he doesn't trust these tools or people's use of these tools, and I don't blame him. And also, he knows that in the long run, things work out well. The problem we've got is that there's so many people in America right now who are approaching retirement who don't have even enough money to retire on. And if it gets cut down in 50%, by 50%, they're really in trouble. And they're going to have to take money out of the market to live on at the low price, which is going to destroy any chance of staying retired. So this is for you guys. And believe me, I'm just going to say this right now. This is not advice. It's not recommendations. It's just education and entertainment. And you really should seek the advice of a professional who understands your particular situation and can give you good advice. And then you should listen to that advice and make your decision. So don't take this as any kind of gospel. It's just education. But here it is.
And everything I'm talking about is my own opinion or my dad's own opinion. Right. And it's totally just me talking about myself. And it's Dad talking about himself.
Yeah. And this is why people don't talk about this stuff to you guys, because it's scary. I mean, you got the SEC out there to regulate this kind of talk. And they are very aggressive about going after people who are encouraging novice investors who don't know anything to do stuff like trading or options, or
we're not encouraging
afraid
any
you're
of
going to lose money, and we're not encouraging any of that. We just
literally what's happening here is you're teaching me some stuff.
Yes.
If people want to listen, that's wonderful.
Yes. So here we go. We're gonna take a look at moving average, and then the moving average convergence divergence, and one more thing called the stochastic. So the stochastic is known as, or stochastic oscillator as it's sometimes called, is another momentum indicator. And it basically says that that this market can be overbought and oversold. So stochastic is looking and saying, oh, here's where more people than usual have bought into this thing, meaning it's peaking, and it's very likely to have no more buyers in the future because they've all bought.
Wait, sorry. Can you say all of that again?
Yeah. Overbought means that, historically speaking, the stochastic measures overbuying and overselling based on prices again.
Okay.
So it's all using prices over time, but using them in different ways. So in this case, the stochastic indicator often is structured as a 14-day, 5-day, 0-day kind of an indicator. And they put on a couple of lines through it that are at the 80% and 20% positions on the movement of the stochastic. And I'm, again, not going to get all deep into this, except just to say that you can look these up on Google and get a whole education from Investopedia, and you can take it sort of line by line and learn about them. But in general, Daniele, this is just an indicator that shows that too much buying is going on, and historically that means it's about to roll over and go down.
What does that mean? You're overbuying and overselling. What do those words mean?
Well, it's
too much buying is happening. What does that mean?
It's a reflection of sort of historical buying patterns in this particular index. And what we know is that nothing goes up forever, right?
Right.
Like nothing, no price just keeps going up, 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 up. Eventually, people who owned it at the low price and now have made a lot of money at the high price are going to start taking their profits.
Okay.
And when they do, if there's no more buyers, because all the buyers bought, then the stock price has to go down because all there are sellers. Does that make sense?
That makes sense.
Okay. So by looking historically at the price movements in a particular index through this stochastic oscillator, the stochastic is saying, based on history of this index price movement, we have had so much movement up that there aren't any buyers left. Just historically looking back.
Yeah.
Could it be wrong because you're looking at a cloud? Yeah. Okay. But historically looking back, this is a place where this thing rolls over, and it calls that overbought, and it produces a signal that says that this is overbought and now it's going down. It produces a signal for that. Okay. And that signal is when the stochastic oscillator line crosses the 80% line on the stochastic. When it crosses downward through that line, indicating prices are moving down over time in a certain speed, then this market's called overbought and you better get out. And the opposite occurs at the other end. Once it's gone way down, then there's no more sellers. And historically, people start buying this company or this stock, then it starts to move upward through the 20% line. That's an indication that it's oversold and it's time to get in.
So it sounds like what it actually does is compare current, I can't tell if it's prices or if it's volume.
It's prices.
Purchasing. Okay.
Not volume.
So it sounds like it compares today's prices or the 14-day moving average price or something like that to historical versions of that price in that company, and then produces a result that is termed overbought or oversold.
Yeah, and this thing can stay. The stochastic indicator can stay above the 80 line for a long, long time. It just can stay there, indicating that you shouldn't take any action other than what you have. And then when it drops down below the 80 line, then it's time to exit. And when it comes up through the 20 line eventually, then it's time to get in. But we've seen these indicators tell us to stay in the market for long, long periods of time. And I like the stochastic for that. It reduces the in and out trading volume substantially. So what I mean by that is you look at all three of these together and you set them, if you're in, let's say, an SPY index in your 401k, and you wanted to take a look at what these were going to tell you to do, you would set the periods to 1 month, so that on your computer you have an opportunity, usually in your brokerage account, you have an opportunity to set the periods any way you want them. And
the time period.
The time periods. So, for example, I've said that...
Sorry, you just skipped over something. The brokerage accounts tend to offer these charts?
They all offer these charts, yeah.
They all offer these charts.
Yep.
Okay.
So you'll go to your brokerage account, you'll look at stock charts on the SPY index. So, and up will come this chart, and then there'll be some place on your account where it'll say, set up a chart for indicators, or something like that will be on your, each one of them is different, but something like that will be on your,
some way to adjust it to where you want it to be.
Yeah. For example, at Thinkorswim and TD Ameritrade, they call it studies. And I think at Interactive Brokers, they call it studies as well. or indicators. So you look at that and find this thing called, let's say, a stochastic, and it will come on. You'll click on it and say, tell it to appear on your chart, and it will show up with the default numbers put into it. Typically 1450 on a stochastic oscillator. And that will then begin to put arrows on there or show you the crossovers on the stochastic on that chart. And then it's up to you to tell it what period you want. And it defaults to a daily period. So you can set the periods. And what I'm saying is set the periods to monthly and slow this whole thing down, because what you're looking for is just enough information to get out of the market when it starts to really crumble.
Why monthly? Why not 3 months or 6 months?
Because when you're running 3 months or 6 month periods, your time change is so slow that the market movement will have already occurred completely by the time it indicates you should get out. It's way too slow. And if you do it on a weekly basis, it's way too fast. So for me, just playing with it, it just works out better. Looking at back testing this stuff through a lot of time periods, it works out better at a month. And interestingly, the 1 month periods on these tools approximate the death cross pretty well, which is done on a daily period.
Okay.
Isn't that interesting? So that's to me it is. It's like we have more and more of us seeing the train rather than the bunny at the same time.
Dear.
And that ultimately is the point, is that a lot of people are trading on this and you need to know about it. So, okay, now you get 3 tools. You get the moving average set on 10 periods. You get the MACD set on, it's going to default to a 26-12-9, and I change it to it's actually structured as 12-26-9, and I change it to 9-17-8. And that just works better for me. But you can put it in as the defaults and it's all good. And then you put in the stochastic at 1450 and then look at the chart of the SPY. And what you're going to see, if you've done this right, so you'll know if you did it right or not, is that you're going to see that the SPX, based on a monthly structure here, let me get it right. I'm putting mine on here.
You guys, this is so his opinion right now.
Yeah, this is my opinion only.
Oh my gosh. I'm struggling. So I'm not even going to get into what the heck the stochastic is measuring, because apparently it's a reflection of some kind of ratio between historical prices and the current price. But I have no idea how they create some sort of mysteriously undefined historical price and then compare it to the current price.
Well, they don't really do that, actually. It's the historical price is baked into the moving average. So it is historical, but it's in the moving average. So,
I do appreciate that there are mathy people out there, and I'm sure we have some of you listening. I really appreciate you for creating such interesting tools as this, because I think it is beautiful that people try to quantify, predict, analyze, and graphically measure what people do in an unpredictable market. I find that fascinating on a very high level. Now, I don't really want to know how these things are created, but I really appreciate you guys just for doing it and for trying to crack the code that is humans being utterly fallible and a lot of the time not having a clue why they do something. I really enjoy it.
Which is exactly what we're looking at here. But you know what? It doesn't have to be rational to work.
Well, and it doesn't have to work to be fascinatingly rational.
Wait, I don't understand that one. Wait.
Like, whoever created these things is definitely totally rational and probably a total genius, but that doesn't mean that they predict anything proper,
No,
like,
of
as you
course
said
it doesn't.
a million times. So what I'm saying is that they don't have to work for it to be still utterly rational in its own universe.
Right, true. But let me just tell you something, just as that you can back test and check for yourself, is if you were to put these indicators the way I just told you on monthly periods, and then you were to take a look at the SPY, right, the exchange traded fund and you looked at that starting back in 1999 when it was at this huge, had been going up forever. And you exited when you got the red arrows and you got in when you got the green arrows, you would have tripled the money in your account at the end of these 18 years than you would if you didn't do that.
Now, why are you saying that after all of the discussion about how these are unreliable and non-predictive?
Because they have a certain reliability and predictability quality to them if used on the SPY. And I'm really hesitating to say that, because let me finish here, because it's real important you get this, is that at least they have had that looking backward on them. And that's a huge disclaimer, because we often see patterns on hindsight that were impossible to see looking forward. And so there's that huge risk that while looking backward on them, we can see that they worked wonderfully well and produced a much higher rate of return. Looking forward, they may not work at all.
Well,
so I'm just saying.
That's what I was about to suggest. What if you started in 1990 and saw how many arrows there were in those intervening 9 years that you didn't count that maybe were completely incorrect? I have no idea.
Well, you can find out, because you can backtest that.
You can find out. Yeah.
Yeah. You can go back, look at a chart starting in 1990 and walk forward month by month, make a determination when you had 3 red arrows and you got out, and a determination when you had 3 greens and you got back in. And if you did that over the intervening 30 years, you might find that this actually turns out to be a null effect. But I will tell you, I suspect you will not find that. It would not be a null effect. It would be a detrimental effect because of transaction fees. Because of transaction fees, potentially it would be negative, even if it turned out to be the same. I think it won't turn out to be the same. I think you're going to find that you'll at least double your money over time, because these things are really good at getting you out before a big drop. And we've had some enormous drops in that interval. Where these won't work very well, I think, and where you probably won't do well, is if the market is fluctuating in a narrow range for a long period of time. And then you'll find yourself getting whipsawed. You get out just as it starts to go back up, and you get in just as it starts to go back down, and you keep getting whipsawed in this horrible death of 1,000 cuts, because the market's not going anywhere, and you're paying all these prices for getting in and out. These tools, though, have done pretty good at not having that happen in the last 20 years. I will say that. On hindsight. So on that note, I would love to quit talking about these. I feel really bad that I ever got into this subject, except for those of you who want to explore this and backtest it and are looking for something when you have nothing to determine when to get out of this market. This would at least be something. It is a thing. Yeah, it is a thing. All right, then now let's move on, shall we? Let's move on. But I'm glad we talked, as I've said multiple times, I'm glad we talked about it so that we know what they are, have some general knowledge. I don't know if I'm ever going to look them up, but maybe I will. I don't know. Well, as long as you're buying individual companies, there's really no point in looking these things up. Yeah, I don't really have to do it, right? Right. Because you're making decisions about owning things based on the relationship between the price of the company and its story and the value of the company. And if the story changes, you're going to change your investment. If the price changes, you may change your investment. So, you may add more, you may decide to sell. So you don't need these tools if you're a value investor and you are working with individual companies. These are only for those of you who are not value investors, who are just doing what everybody's taught you to do and investing and holding, and you're scared to death. This might help you. And on that note, time to go play. All right. Thanks, everybody. Bye. Bye. Hey guys, thanks for listening to Invested. If you enjoyed this episode and you want more information, show notes, and more episodes, visit us at investedpodcast.com. There's a special offer waiting for podcast listeners to attend my 3-day investing workshop absolutely free. So just head to investedpodcast.com. Everything discussed on this podcast is either my opinion or Danielle's opinion and is not to be taken as investing advice because I am not your investment advisor, nor have I considered your personal situation as your fiduciary. This podcast is for your entertainment and education only, and I hope you enjoyed it.